Hey guys, today I wanted to talk about Uber stock and why I think it has 2x potential from here. Stay tuned to the end so I can prove it to you with a DCF. So I'm sure all of you know what Uber does, so probably most of you have even used their services this year. So I'm not going to really dive into that, but one thing I wanted to show you that Uber's problem was struggling for with a while was that the company was never profitable. The company never generated free cash flow. It had amazing reach, amazing app. But that story has changed since, the second back half of 2022 here. If you take a look at this chart, Uber's been generating plenty of free cash flow ever since 2022 when they broke even, and now to the point where they're generating $8.7 billion in free cash flow. And I bring that up because a competitor I see is Tesla, especially in the autonomous vehicle robo taxi space. And I wanted to highlight this first because when a company's able to generate free cash flow, they don't need to pull on debt. They don't need to pull on equity. They don't need to dilute shareholders to raise money. They don't need to raise debt at an expensive interest rate to help fund these ideas. Uber already has the free cash flow and the operations in place. I'm a firm believer in that a company's free cash flows track its price over time. So when you look at those two metrics plotted out, you can see the market cap since 2022 has increased by 300%, but more importantly, free cash flow has increased by 2,000%. So I don't even believe currently Uber's getting the credit for what they've done, how they've been growing their user base with the multiples and price they're trading at now. I mean, they are generating substantial amounts of free cash flow. It is very impressive. And another chart I wanted to show you, right, was the stock-based compensation as a percentage of revenue here. And you can see in that purple line, it's dropped quite significantly. I mean, they've been doing a very solid job of holding that stock-based compensation constant, even as they've scaled and the stock prices increased, free cash flow has increased. I mean, it's what you like to see as an investor. And two key metrics Uber focuses on to kind of help judge their performance was the monthly active platform consumers and the monthly trips per, monthly active platform consumer. And both of Uber's active users and trips per active user hit an all-time high in Q3 2025. And I just don't see it being reflected in the price and the multiple. I mean, there's a lot of weakness around this stock, and I don't know if it's because there's consumer spending weaknesses, and you saw what happened. DoorDash just got absolutely crushed, but I mean, Uber is just rolling and has momentum going right now. I mean, the fundamentals are beautiful, the industry tailwinds are beautiful, the valuation's beautiful. I mean, they got everything working for them right now in their direction. And just to really solidify this and put this into perspective for you, here are the three major players: Uber, Lyft, and Dash. And right, Lyft and Dash are slightly different in the sense that DoorDash doesn't, offer ride servicing, ride hailing. It's solely just delivery. But you can see that Uber added 644 million trips from Q3 24 to Q3 25, while DoorDash only it did 133 million and Lyft did 32 million. I mean, from 1 year growth here, Uber did grew about 4 times the size of DoorDash and Lyft combined. And keep in mind, they have way larger revenues. You know how much harder it is to grow trips, grow revenues at a company that already is at mass scale and mass size. I mean, these companies, Uber has way more monthly active users, there's way more revenue. It's a lot harder. The law of large numbers. Stuff gets bigger, it's harder to keep growing. Uber keeps finding a way and they're blowing the competition out of the water. So I wanted to walk through three sections that I think is pretty important in regards to valuation, growth, and profitability across Uber and some of their competitors being Instacart, DoorDash, and Lyft. So if we take a look at the first one here, just looking at the forward multiples, enterprise value to revenue, you can see that Uber trades in the middle of the range here. You know, it's above both Cart and Lyft, but below DoorDash. If you take a look at their EV to EBITDA, they trade below Dash again, but kind of in the middle here above Cart and Lyft. And if you look at their, and these are all forward looking, by the way, and if you look at price to earnings ratio, Uber's at 22 times, right in about the middle of the pack, with DoorDash being at top at 37 times. Now, what's interesting is you kind of digest that for a second and see, you know, one, for a company growing this size and a rule of 40 company, you know, 22 times price to earnings for Uber, especially with the advent of autonomous vehicles and robo taxis and those industry tailwinds hitting them, in my opinion, is looking pretty low. Okay. And if you look at the revenue growth, you can see that Uber has slowed in the LTM versus Dash. If you look back over 5 years, Uber's outperformed Dash in terms of revenue growth. But if you look at, you know, the last 12 months and the 2 years, you can see why Dash is starting to command that higher revenue multiple, is because they're growing faster. But in my opinion, are they growing faster on an absolute means? No. I mean, percentage wise, they're growing faster, but you have to remember how large Uber is. I mean, growing this much and being growing much larger in terms of revenue is a lot harder to do with the law of large numbers and the scale and size that Uber's at. You remember, if we take a look back to that other slide with the total trips, a better way to look at it, not as a percentage of revenue, they're smoking everybody. Okay. And if you take a look at free cash flow margins, Uber's been solid, 18% free cash flow margins, 16% free cash flow margins, and it's right in line with everyone else's, but Uber has much better profitability in terms of controlling stock-based compensation, controlling certain expenses while expanding into, you know, so many different verticals in the sense of robotaxi, food service, right? Like Instacart is just delivering, DoorDash just delivering, Lyft. They'll pick you up and ride. You know, in my opinion, DoorDash is the best. Just taking a look at the growth rates, the free cash flow margin, the size they're at, and the industry tailwinds. I just wanted to show you guys with the DCF here, the potential Uber has. So first I'm going at 2026 revenue and growing that to the point of analyst estimates here at just about 60 billion. If you go forward, I'm growing revenue by 15% for the next 10 years. Uber has historically grown in the 12%, but I think with these industry tailwinds pushing them forward with autonomous vehicles and robo taxis, then I think they'll achieve above that and work closer to the 15, probably above that. But I have their revenue at a quarter of a trillion, just about $219 billion annually in the terminal period from 2036 to forever. Now, I have their adjusted EBITDA margin at 20% for the first 10 years, and then I have it at 25% for the terminal to account, you know, in the next 10 years, they can improve their margins. And, you know, if they can really find a way to cut out those drivers and really push towards full autonomy and robo-taxi, I mean, they're going to really become way more profitable than what they are now. And running that through the model, we get our EBITDA values, and then we want to subtract out depreciation because depreciation is non-cash expense, right? We want to get to a free cash flow level here. So after we strip out depreciation, we're stripping out taxes, and after taxes, we get NOPAT, net operating profit after taxes. Then we just add back in the depreciation and amortization because it's a non-cash expense, so we shouldn't be expensing that. We're adding it back now. And then we get to adjusted gross cash flow, and you look at the change in net working capitals. And change in net working capital is the former year minus the year to come times the change in this net working capital, which you can look at as current assets minus current liabilities as a percentage of revenue. And then you can see when you scale up revenue, I have in my assumption 3%. You get more bills as you scale up in size. That's what you're accounting for in net working capital, right? You grow from 1 million to 10 million in revenue, you can bet you're going to have more expenses. And that's what net working capital is capturing. Next up is capital expenditures, and historically they've been at like 0.5%, 0.6%. They're very, very light on capital expenditures. I mean, unlike they're not like Hertz here. They're not buying their fleet. They just have people with cars signing up to work here. And then we get to our invested capital and net cash flows, which basically is free cash flow. And then we're going to bring it back to the present value, right? A dollar today is worth more than a dollar tomorrow. So one divided by one plus the discount rate raised to the projection period minus a half to account for that mid-year when you're getting that cash flow in. We'll utilize, these following values from 8.5 billion all the way to 283 billion. And why it's so large in that period is because it's the perpetuity. Everything after 2035 is from 2036 for the rest of their life. So that gives us present value cash flows 105 billion, present value of terminal value 283 billion, for a combined value of just about $389 billion. And they have about 2.1 billion shares, just about, which gives us a price target of $187. It currently trades at $91. I mean, there's over 100% upside. I mean, this thing can easily double in the sense that it goes from 90 to 180 like that. And I think they really have the potential to execute with these industry tailwinds. That's it. That's all I had for you guys. Let me know in the comments if you would buy, hold, or sell this stock. I'm personally a buyer. I love it. I think it has a lot of upside potential from here. See you in the next one, guys.